money market funds have been getting super popular recently. That's because they are currently offering almost 4% yield, which is quite close to other safe investments like government bonds, fixed deposits, and even savings accounts. And the good thing is that money market funds don't require you to do this and do that to earn the high yield, unlike most banks. On top of that, if you look at any chart of a money market fund, it seems like they are immune to market crashes and can only go one way, to the moon. So, in this video, I'll be talking about everything you need to know about money market funds. What is it? How does it work? Are there really zero risk? Then, finally, I will share which is the best money market fund that you can invest in. Also, I've recently set up a Telegram channel which you can join to ask questions and discuss everything related to money. So, do check it out. And with that being said, let's jump right in. So, what exactly is a money market fund? In simple terms, a money market fund is a fund that invests in highly liquid, short-term instruments. Let's break this down. By highly liquid, it means that there's no lockup period. You can invest and redeem whenever you want. So, for example, if you are investing in a money market fund via Webull, you can withdraw and get back your money by the next business day. This is super good because if you look at other investments like bonds and fixed deposits that offer similar yields, typically, you will need to wait for a few months before they mature and you can get back your money. They'll be like, you want to get back your money, you wait long. Meanwhile, money market funds be like, you want to get back your money? Can, no problem. Not just that, if you are investing in money market funds through brokers, the brokers will let you immediately use the money to buy stocks and ETFs. Next, money market funds invest in short-term instruments like your T-bills, corporate bonds, and fixed deposits. If you look at the holdings, a large part of it has maturities of under 4 weeks. Not just that, the stuff that is investing in is extremely safe. For example, for the Lion Global Money Market Fund, over 55% of the fund is in the government sector, like MAS bills, T-bills, LTA bonds, and so on. They are almost risk-free and won't really lose money, unless there's a nuclear war, of course. Then, 28% of the holdings is in the financial sector. What? Financial sector? You mean banks that can boom and collapse? Okay. For this, you don't have to worry because of two things. First, the weighted credit rating of money market funds is quite good. For this fund, it's AA-, which puts it in a high grade rating. Or in other words, the holdings have very little default risk. Second, because the maturity of the holdings is so short, when the holdings mature, fund managers will quickly buy new instruments to replace it. This means the fund is constantly adjusting to a changing interest rate environment, thereby reducing risk. As mentioned earlier, money market funds are so safe that we don't see them being affected by any market crashes. Not during the 2018 crash, 2020 crash, and even the most recent 2021 crash that made a lot of people lose money. Here's another chart. Over the past 30 years, while every other investments have been going up and down, money market funds have been super steady from PP. Quick pause. I'm sure by now, most of you would have heard of Webull's famous zero commission free trading and their fractional shares feature. So, let me share 3 more new features that you may not have heard of. First, Webull has added a regular savings plan, which means that now you can fully automate your investments with them. 2. Webull lets you park your idle funds with them to earn up to 4% worth of yield. And third, for people who want to trade options, you'll be glad to know that Webull now supports both covered call and cash covered put. So if you have not signed up yet, you can sign up with my link down below. Fund your account with 100 Singapore dollars and hold the funds for 30 days. And you will get anywhere between 6 to 40 free fractional shares worth up to $1,000 each. With that being said, let's get back to the video. This is also the reason why brokers and robo-advisors are now offering money market funds as a low-risk place to park your money in. For example, Webull lets you park your idle funds in the Fullerton SGD Cash Fund. Same for Tiger Brokers and Moomoo Singapore. For robo-advisors, most of them have a money market fund in their portfolios. The reason some portfolios don't have a money market fund is because they are trying to go for a higher risk, higher reward. And how did that turn out? When times are good, portfolios that don't have a money market fund tend to perform better. But when times are bad, portfolios that have a money market fund in it tend to perform better. So that's the characteristics of a money market fund. It's highly liquid and invests in short-term, low-risk instruments. Then you'll be like, so you mean I can park all my money into money market funds? Hold up, before you do that, you need to understand that money market funds are not entirely risk-free. So what are the risks? First, the price can fall. While this has not happened to Singapore money market funds yet, there were only 2 times where the US money market funds lost money over the past 50 years. One of them was in 1994, when a money market fund was liquidated due to large losses in derivatives. Another was during the 2008 financial crisis, where investors were panic selling their holdings because they were worried that more financial institutions were going to collapse. So losses can happen, but they are rare. It would take some big catastrophic events to cause money market funds to lose money, like widespread bank runs, nuclear war, alien invasion, and so on. While this may seem super scary, it's actually not as bad as you may think. For the 1994 money market fund loss, it only dropped from $1 to 96 cents. And for the 2008 loss, it only dropped from $1 to 97 cents. So the losses are quite small. In fact, over the last 20 years, the maximum drawdown of money market funds is super small. It's even smaller than other low-risk asset classes like corporate bonds and UK government bonds. Second, money market funds are not insured against losses. So when you keep your money in a bank, you'll be insured up to 75k per account. There's no such insurance for money market funds. But you don't really have to worry much because, as mentioned, money market funds are designed to be very low risk. So there's very little need to be protected against losses. Third, the investment platform can collapse. So one thing you need to know is that MAS requires brokers and robo-advisors to keep our money and investments separately at another company. That way, even if the platform boom and fails, our assets are still safe. This happened to a robo-advisor called Smartly, which shut down in 2020. Investors were given the option to either sell the holdings or transfer the funds to another new robo-advisor. So the risk here is not so much about the platform collapsing and we lose everything. This won't happen due to MAS regulations. It's more about during the collapse, we may not be able to access our funds immediately, and it may take a while to get our money back. Final risk, fluctuating interest rates. So this is quite straightforward. Because the maturity of the holdings is so short, whenever the fund updates its holdings, the yield will go up and down accordingly. So when the Fed eventually pivots, you will start to see the yields drop. On the other hand, if you have invested into SSB or fixed deposits, you'll be able to lock in a high yield for a much longer period. But again, this is not an issue because the whole reason you are investing in money market funds is because you need liquidity. So you won't really bother about falling yields anyway. Alright, now that you know the risk, we are now ready to talk about the fun part. Which money market fund should you invest in? Check this out. Currently, the 4 most popular money market funds are Fullerton SGD Cash Fund Class A, Lion Global SGD Money Market Fund Class A, Phillip Money Market Fund, and the United SGD Money Market Fund. All of them are accumulating funds, meaning rather than paying out dividends, they just reinvest the dividends back into themselves to activate the magic of compounding. So, which is the best fund? If we look at the 10-year performance, the Lion Global Fund gave the highest return. But since the United SGD Money Market Fund came out in 2019, it's better to look at the 3-year performance instead. Here, you will notice something really interesting. While the Lion Global Fund has been the top performing fund, around July 2022, the Fullerton SGD Cash Fund started to cash up. And if I change it to 2 years, you can see that the Fullerton SGD Cash Fund overtook the Lion Global Fund and outperformed it. Not too sure what happened there, but I suspect that it has something to do with the fact that the Fullerton Fund's top holdings are made up of corporate bonds, whereas the Lion Global Fund top holdings consist mainly of government-related bonds. Another thing that helped is that Fullerton Fund's expense ratio is just 0.15%, whereas Lion Global Fund's expense ratio is slightly higher. So if you want to go for the highest yield and lowest expense ratio, the best fund would be the Fullerton HG Cash Fund Class A. As to where you can invest in it, currently it's being offered by almost all the platforms out there, like Webull, Tiger Brokers, moomoo Singapore, Endowus Fund Smart, Moneybull, Wise Saver, and Poems. Though, I would recommend using the brokers to invest because they don't charge you any fee for investing in the funds. And also, they let you immediately invest the money into stocks and ETFs without any delay. Sign up links down below if you are interested, yeah? Anyway, that's all for this video. Hopefully, you find it useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.